Hello, today I'm going to teach you about the fundamentals of accounting. So we are going to discuss the origins of accounting and the accounting equation. The founding father of accounting is Luca Pacioli, an Italian mathematician, authored Summa de Arithmetica Geometria Proportioni Proportionata in 1494, which laid the foundation for modern day accounting. Accounting is basically the process of recording, processing, analyzing, presenting financial data in a generally acceptable and understandable format to aid in decision. A lot of words. Let's break that down. So, generally, when a business does its activities, it its operations, it might sell something, it might buy something, which creates something called transactions, and those transactions are then recorded, they are processed, analyzed, presented in a generally acceptable and understandable format to the decision makers, to managers, to investors, to lenders, so that they may make um, educated investments. The accounting equation is asset plus liquidity plus ownership. Asset equals to liquidity plus owner's equity. So asset is the total number of resources, all the resources you can imagine, motorbike, machineries, cash, all the resources of the business, equal to the obligation towards third parties who have put forward some of those resources, and the owner of the business who has put forward some of those resources. So third parties have donated some resources like loans or maybe a machine or something, and the owner of the business has donated, or sorry, given, not donated, given some of those resources. The combination of obligation towards the third parties and obligation towards the owner equals asset. Um, sorry. If we break down owner's equity, we get capital, revenue, drawings. If we play around with this formula, we'll get asset plus drawings plus expenses equals to liability plus capital plus revenue. Same formula, just these two components went here. Debit and credit, we have all heard about it, but seldom we understand the implications of it. When these three components of this equation increase, like when cash is a asset, when cash increases, we'll call it debit, and when cash decreases, means you don't have enough cash anymore, or you have paid someone something, it's called credit. In this case, when these three components increase in value, it's called credit. So if loan is, what a D. Loans is part of liability. So if it's a liability, if loans increase, if we take a loan, then we have credit. If we pay back the loan, we'll say the loan is now debit. Same for capital or revenue. Components of that equation. Examples would be cash, cash equivalent, which is like deposits, the money in the bank, uh, current deposits, or savings. Then we have accounts receivable, means you owe people money. Basically, you sold a product or a service, but you haven't been paid. Then land and machine. Drawings is when the owner takes out money from the business. Expenses are cost incurred by the business. Liabilities are accounts payable. This is exact opposite of accounts receivable. In this case, this means that you owe people money. You took a product or service but haven't paid them. Unearned income is you have already taken up the money but you haven't provided the uh, service or the products. Say um, you're selling lemon teas. You've already taken the money for the lemon tea, but you haven't provided lemon. Now, small loans and large loans. What is the difference between small loan and large loan? If a loan's duration is less than 1 year or 1 year, it's considered as a small loan. And if its duration is more than 1 year, it's considered a large. Capital is when the owner puts money into it, and revenue is money generated by the assets can be divided into three segments: current assets, non-current assets, investment. Current assets are assets that are most liquid. So uh, liquidity. Sorry for my spelling. Liquidity basically means, let's say you have $5,000 worth of a car and you're going to sell that car. So liquidity means how fast you can turn this asset into a cash without losing too much of its value. If you sell this car tomorrow and you get $3,000, that's not a very liquid asset. If you sell that car tomorrow and you get close to, $4,900, then you'll say the asset is more liquid. So basically, how fast you can sell an asset without it losing too much of its value. That is liquidity. So current assets are the most liquid forms. So we have on top of that cash, cash equivalent, or again depositories, accounts receivable, prepaid expense means you have already paid for an expense. You have already paid for next month's electricity bill in advance, or inventory. Non-current assets are assets that are um, not that liquid. For example, we can divide this segment into tangible and intangible. Tangible are machineries, land, building, vehicles, fixed furniture. Intangible are patents, copyrights, and credit. Good. And then we have investments. Investments in stock, bond, ETFs, exchange trade funds. Intangible means something you cannot touch. Another example would be goodwill. Goodwill, something you can't touch. Liabilities. Liabilities are obligations towards third parties of the business. So let's say accounts payable, I've already discussed it. Loan duration 1 year of I've already. So current liabilities are more liquid liabilities. Fixed liabilities are like non-current asset, more illiquid liability. Expenses can be divided into operating, non-operating, fixed, and variable. And there's something in between called semi-variable. I'll discuss a difference between this, and this on later on videos. Like, share, and subscribe. Thank you.